Good afternoon, everyone. Welcome to this NZASB webinar on Exposure Draft PBE NZASB 40 PBE combinations. My name is Amy Lewin. I am Senior Project Manager of Accounting Standards at the NZASB. Before we make a start, just a couple of housekeeping matters. The presentation slides will be available on our website tomorrow. We welcome you to ask questions during the session. You can do so by typing the question in the control panel on the right-hand side of your screen. One of my colleagues is monitoring the questions, so if it is something simple, we will provide an immediate response. If it is a common question, we will share this with everyone at the end. If we get a more complex question, we will respond after the webinar. And for those who have all registered for the webinar, a link to the recording will be available over the next couple of days. I'm pleased that this exposure draft has been issued, and I now have the opportunity to tell you about the proposed standard. So unlike revenue and expense transactions, combinations don't happen every day. So when entities have a combination, preparers and auditors often need guidance on the accounting for amalgamations and acquisitions. So to keep this webinar interactive, we will do polls throughout the session. So the first two polls is to get an idea of our fears. So the first poll is on what sector do you represent? Sorry. Okay, so I'm just going to give you a few seconds there to provide a response. So it's A, public sector, B, not-for-profit, C, both public sector, and D, C, both public sector, not-for-profit, D, other. Okay, so I'm just going to wait for a couple more responses before I close off. Right, okay, so I'm going to close off the poll now. Right, so the results is that mostly you're not-for-profit, and 42%, and then 24% in the public sector, and then 26% in both public sector and not-for-profit. So the second poll that we have is which group best describes you or the organisation that you work for? So A, a preparer, B, a user, C, a regulator, or D, an auditor. You could just give your response to one of those options there. So I'll be closing this poll soon. Okay. Right, so it seems like most of you are preparers of financial statements, and the other large proportion is auditors. So thank you for answering those questions. Okay, so the presentation will cover the material on this slide. So I will provide some background on the proposed standard. So what are the changes to current practice? How to classify a combination as either an amalgamation or an acquisition, information about amalgamations and acquisitions, the transition requirements and the effective date, and we will have time at the end for questions. So we currently have PBE IFRS 3 business combinations. So this standard is based on NZASB 3, which in turn is based on IFRS 3. The scope of PBE 3 is limited. It mainly covers acquisitions. So if the combination was in scope, then the entity had to apply acquisition accounting, and an acquirer had to be identified. And this has proved to be challenging for some entities in the public sector and not-for-profit sector. If the combination was out of scope, then entities had to develop their own accounting policies because there is no specific standard on amalgamations. So when we issued the PBE standards, the NZASB did not have a standard on combinations. So we developed PBE IFRS 3 based on NZ IFRS 3. The public benefit entities have been already applying NZ IFRS 3, so there was little impact when PBE IFRS 3 was introduced. The NZASB started its project on public sector combinations in 2008. So after one consultation paper and 2 exposure drafts, the NZASB issued the final standard IPSAS 40 public sector combinations in January 2017. So when the NZASB issues a new standard, the New Zealand Accounting Standards Board considers the suitability as a PBE standard. So the NZASB considered IPSAS 40 and thought it was desirable to issue a PBE standard based on this IPSAS. And the main reason being that IPSAS 40 fills a gap, the accounting for amalgamations. So public sector entities engage in both amalgamations and acquisitions, and IPSAS 40 covers both these types of combinations. As already discussed, the scope of PBE IFRS 3 is limited. It mainly covers acquisitions. So this presentation will mainly focus on the accounting for amalgamations because this is not addressed in PBE IFRS 3. The accounting for acquisitions is based on PBE IFRS 3, but I will still outline any differences between the current standard and the exposure draft later. So we are interested to know how many of you have dealt with combinations in the past. So if you could just take a few moments to answer this next polling question. So which type of combination have you dealt with in the past? A, amalgamation, B, acquisition, C, both, D, neither. Okay, so just giving you a couple more moments there to provide a response. Okay, so I'm about to close off the polls now. Okay, so it seems like the majority of you have dealt with both acquisitions and amalgamations. And then coming next is that you've not dealt with any type of combinations. Right, okay, thank you for that. Okay, so what are the proposed changes to the current requirements? So the first difference is the scope. So PBE IFRS 3 excludes business combinations arising from a local authority reorganisation. So for example, if you still remember the Auckland Council mergers. And it also excludes combinations under common control. So for example, combinations between subsidiaries or government departments where the government is the ultimate parent. This exposure draft applies to all PBE combinations with some exceptions. So for example, the formation of a joint arrangement is out of scope. The second difference is classification. So PBE IFRS 3 classifies all combinations within the scope of the standard as an acquisition. So there was no need to distinguish the type of combination. The exposure draft, the scope covers both amalgamations and acquisitions. So combinations are classified as one of these types. The exposure draft proposes an approach to classifying a combination as either an amalgamation or an acquisition. Sorry, I've just been told that the polls have still not been closed. Right, okay. Okay, right, so I was just saying that the ED proposes an approach to classifying a combination as either an amalgamation or an acquisition. So I'll discuss this shortly. The third difference is the accounting for amalgamations. So PBE IFRS 3, this standard only deals with acquisitions, so there's no requirement for amalgamation. The combinations within the scope are accounted for as an acquisition, so one of the parties had to be identified as the acquirer. The exposure draft contains requirements for accounting for amalgamations, and the presentation will be focusing on these requirements. The fourth difference is the recognition of goodwill. In an acquisition, an acquirer can pay more than the fair value of the acquiree's net assets. The exposure draft has additional requirements as to when goodwill can be recognised. Goodwill is recognised if the acquisition results in net cash inflows to the acquirer and the acquiree is a cash-generating operation. In PBE IFRS 3, goodwill is recognised if the consideration transferred exceeds the fair value of the net assets acquired. So before you can account for the combination, you have to decide whether the combination is an amalgamation or an acquisition. To do this, you go through the classification approach. This initial step is important as it determines how you account for the combination. So the first question to ask is, has one party gained control of one or more operations? And the concept of control here is based on the principles and guidance in PBE IFSAS 35, Consolidated Financial Statements. For example, you will look at the power over an operation, exposure or rights to variable benefits, and the ability of the acquirer to use its power to affect the nature or the amount of those benefits. If the answer to the first question about gaining control is no, then the combination is classified as an amalgamation. If the answer is yes, then you need to consider a second question. And the second question is the economic substance of the combination an amalgamation? This is probably the more tricky question and will involve judgment. There could be combinations which look like an amalgamation, but is in substance an acquisition, and vice versa. In answering the second question, you look at the indicators of consideration and decision-making process. And this should help decide the type of combination. If after looking at these indicators, it's decided that the combination is not an amalgamation, then the combination is classified as an acquisition. If after going through all the questions and indicators, there is still some concern about the likely classification or the results are inconclusive, then you consider which classification would provide information that meets the objectives of financial reporting and satisfies the qualitative characteristics. To answer the second question, is the economic substance an amalgamation? You look at the indicators of consideration and decision-making process. The first indicator is consideration. A combination with no consideration is not necessarily an amalgamation. There could be acquisitions where there is no consideration transferred, such as a donation of an operation or a bailout of an organisation in financial trouble. If the parties are under common control, then consideration is not necessary. In this case, it would be appropriate to classify this as an amalgamation. So the key point of this indicator is to consider why consideration is not paid to compensate those with an entitlement to the net assets of a transferred operation. The second indicator is decision-making process. The following indicators provide evidence of an amalgamation. And an acquisition usually requires the voluntary participation of all the parties to the combination. If a PBE combination is imposed by a third party without any party to the combination being involved in the decision-making process, This may provide evidence that the economic substance of the combination is an amalgamation. A combination under common control generally indicates that it is an amalgamation. For example, a government may decide to combine two ministries for administrative or political reasons. In some jurisdictions, a citizen referendum occurs before the combination takes place. This provides evidence that the parties to the combination do not have the freedom to voluntarily effect the combination, and that the ultimate decision as to whether the combination takes place is dependent on third parties. However, it is possible for citizens to approve through referenda combinations whose terms are those of an acquisition. I thought it would be helpful to clarify some of the new terms in the exposure draft. The first one is the resulting definition of the resulting entity. So this is where an entity that is the result of two or more operations combining in an amalgamation. This is also known as the combined operation. The second term that we've got there is combining operation. It's where an operation that combines with one or more other operations to form the resulting entity in an amalgamation. The simplest way to explain this is with a diagram. So entity A and entity B decide to combine. So these are the combining operations, and they are combined to form entity C, and entity C is the resulting entity. The exposure draft proposes two types of amalgamation. You must be thinking, why is there two? Surely an amalgamation is just an amalgamation. Well, the reason for the two types of amalgamation is that it determines the accounting requirements, such as the accounting policies, presentation, and disclosures. So the first type of amalgamation is where no party to the amalgamation gains control of one or more operations. The resulting entity is a new reporting entity. So for example, Council A and Council B combines to form Council C. Neither council controls the other, and they have combined to create a new entity, Council C. The second type of amalgamation is where one party to the combination gains control of one or more operations, but the combination is classified as an amalgamation. The resulting entity is a continuing reporting entity. So if you remember back to diagram 1, where there is control, but the economic substance of the transaction is an amalgamation. So for example, a local not-for-profit combines with a national not-for-profit. The national not-for-profit is the continuing reporting entity because it has gained control of the local not-for-profit, but the combination is classified as an amalgamation. So this diagram here is an extension of diagram 1. So this diagram shows the type of combinations. So there's two types of amalgamation and one type of acquisition. The diagram goes through the two questions to determine the type of combination and the type of amalgamation. So we have some examples to illustrate these two types of amalgamations. So the first one is the new reporting entity. So A and B combine to form C. Neither A or B controls the other. And C is the newly formed entity that has not been in existence prior to the amalgamation. So entity C is the new reporting entity. And then the example for continuing reporting entity. So A and B have combined. A has gained control of B, but the substance of the combination is an amalgamation. A remains in existence and is the continuing reporting entity. So now that you've established that it's an amalgamation and the type of amalgamation, it's now time for the accounting. So the accounting to use is the modified pooling of interest method. So some of you may have heard or applied the pooling of interest method. And the main difference between the two methods is under the modified pooling of interest method, there's no restatement of comparatives. The modified pooling of interest method is applied from the amalgamation date. So the first question to ask is, have all the combining operations applied PBE standards? If the answer is no, then you would need to apply PBE FRS 47, the first time adoption requirements. For example, a small not-for-profit entity have been applying the Tier 3 standard. It combines with a Tier 1 not-for-profit applying the PBE standards. The Tier 1 entity is the continuing reporting entity. The small not-for-profit would apply PBE FRS 47 to prepare an opening balance sheet in accordance with the PBE standards as at the amalgamation date. The Tier 1 entity would then combine the assets, liabilities, and non-controlling interests of the small not-for-profit with its own assets, liabilities, and non-controlling interests. If the continuing reporting entity has not applied PBE standards, then it would need to refer to NZASB A1, application of the Accounting Standards Framework, for the requirements for moving between tiers. The continuing reporting entity does not go directly to PBE NZASB 40 for the accounting. Instead, it shall go to PBE FRS 47, where it will prepare an opening balance sheet under PBE standards. It can choose to restate any prior period amalgamations in accordance with PBE NZASB 40 or apply the prior period amalgamation requirements. So for example, a small not-for-profit has been applying the Tier 3 standard. It combines with a Tier 2 not-for-profit applying the PBE standards. The small not-for-profit is the continuing reporting entity. The amalgamation has increased the operating expenses of the small not-for-profit from a Tier 3 to Tier 2. It will have to refer to NZASB A1 for the requirements for moving from Tier 3 to Tier 2, and then it would need to apply PBE FRS 47. So if the answer is yes, the combining operations have been applying PBE standards, then the resulting entity recognises the combining operations assets, liabilities, and non-controlling interests as at the amalgamation date. If there happen to be different accounting policies among the combining operations, then the resulting entity would have to decide which accounting policy it will apply. So for example, entity A revalues land and building, whereas entity B carries their land and building at cost. The resulting entity, entity C, decides that it will revalue land and building. So the land and building of entity B has to be revalued so that it's consistent with entity A. If the resulting entity is a continuing reporting entity, it's expected that they will continue to apply its previous accounting policies. If the resulting entity is a new reporting entity, then it would have to decide the accounting policies which is most relevant and faithfully representative of the transactions and events. This is like the land and building example that we've just discussed. So any inter-entity transactions between the combining operations are eliminated in the resulting entity's financial statements. If the resulting entity is a new reporting entity, then it shall provide the information on this slide. No comparatives are provided because the new reporting entity was not in existence prior to the amalgamation. Historical information are required for the combining operations, and there's a couple of ways of presenting this information. The resulting entity can provide the combining operations financial statements from the last reporting date to the amalgamation date, or selective information from the last reporting date to the amalgamation date. The historical information provided for the combining operations are not restated. This means that the combining operations present whatever they have done in the past. The presentation requirements for a continuing reporting entity is slightly different. The first three items on the slide there are information that's required as at the amalgamation date. So unlike a new reporting entity, comparatives are required for a continuing reporting entity. However, comparatives are not restated. So whatever the continuing reporting entity presented in the past, it shall present that same information. The requirements for historical information for the combining operations are the same as the combining operations for a new reporting entity. The accounting for an acquisition is generally consistent with PBE IFRS 3, so the acquisition method is applied. Proposed standard does have some slight differences. So as already mentioned, goodwill is recognised if the acquisition results in the generation of cash inflows and it results from the acquisition of a cash generating operation. There's also more guidance on non-exchange acquisitions without the transfer of consideration. So for example, if you have a forced nationalisation, a donation of an operation, or taking over an entity with net liabilities, such as a bailout. Also, because PBE IFRS 3 mainly deals with acquisitions, there's more guidance on identifying an acquirer, whereas under the exposure draft, there's less guidance on this requirement. So all combinations prior to the effective date are not restated. There is an exception for first-time adopters under PBE IFRS 47, where there is an option to restate prior period combinations. Early application is permitted. The exception is for first-time adopters under PBE IFRS 46. So these are entities who have been applying NZASB and change to PBE standards. They cannot apply this proposed standard to any combinations that occurred prior to their transition to PBE standards. So these entities can only apply PBE IFRS 40 to new combinations after they have transitioned to the PBE standards. So we're proposing an effective date of 1 January 2021. So compared to the transition period for some standards, this may seem like a short transition period. And the reasons for that is that because of the retrospective application, and most PBEs would have been applying NZASB 3 to combinations within the scope of that standard. So the accounting for acquisitions is very similar. As you've seen, the accounting for acquisitions is very similar under the exposure draft and the PBE IFRS 3. So we've got some final polls here, which I would appreciate your response. So the first one we've got there is, if PBE IFRS 40 is issued, when do you expect to apply it? So A, you'll be an early adopter, so as soon as it's issued, within 2 years of issue, after 2 years, you will apply, but you're not sure of timing. And then the last option there, you're unlikely to apply because you probably won't deal with any combinations. Okay, so I'm just going to wait until we get a bit more responses there. So give you a few more moments to respond. Okay, so I'm going to close off the polls now. Okay, so it seems like it's kind of neck and neck, and that unlikely to apply because it's not applicable, but then also the same percentage will apply but not sure of timing. And for those who will apply, probably within 2 years of issue. Okay. Right, so the next final poll is that for those who will apply PBE IPSAS 40, which type of combination will it be for? Amalgamation, acquisition, or both? Okay, so for those who said they would apply the standard, can you just give your response? I'm just going to close the poll in a few secs. Okay, so for those who say that they will apply it, that 74% that it will be applied to both amalgamations and acquisitions, and then coming up second is amalgamations. Right, thank you for that. Okay, so you may be wondering, what is the difference between this exposure draft and PBE IPSAS 35, Consolidated Financial Statements? So this exposure draft establishes the accounting for amalgamations and acquisitions. So the requirements are applied at the time of the combination, whereas PBE IPSAS 35 establishes the requirements for the ongoing presentation and preparation of consolidated financial statements when one entity controls another entity. The requirements are applied on an ongoing basis after the combination has taken place. There is an overlap in both standards, and this is the reference to control. In the exposure draft, control is an indicator of the type of combination. So as already noted, PBE IPSAS 35 requires consolidated financial statements to be prepared when one entity controls another entity. So this exposure draft was issued in September, and comments are due to the New Zealand Accounting Standards Board by 31st of January next year. We have a number of resources on our website. We've got the invitation to comment, so this outlines how to provide comments to us, the questions that we would like responses to, and the changes that we've made to IPSAS 40 in developing this exposure draft. Obviously, we've got the actual exposure draft on the website as well. The requirements is actually not very long. It's only about 50 pages, but there are a lot of guidance in the form of illustrative examples. And these examples mainly focus on applying that classification approach. We also have a in summary document. So this is a high-level summary of the exposure draft, and we have mainly focused it on amalgamations. We also have the marked up exposure draft. This shows and marked up the changes that we've made to IPSAS 40. And then we've also got a link to the original IPSAS 40 standard by the NZASB for those who are interested to see that standard. So if you don't have time to read the exposure draft, I suggest reading the in summary and the invitation to comment. We have made a number of changes to IPSAS 40 in order to be appropriate for New Zealand public sector and not-for-profit entities. So we would really like to know if the proposed requirements would work for you. So in your comments to us, you don't need to answer all the questions. You can choose to answer only those applicable to you. We are happy to receive formal or informal comments in an email or a letter. So We will consider the submissions next year, and subject to the comments, we expect to issue the final standards sometime in 2019. So all the documents that I have been referring to are in the Accounting Standards and Development section of our web page. So the key points from this presentation are: the exposure draft covers amalgamation and acquisition and how to classify the combination. Amalgamations are accounted for using the modified pooling of interest method. For amalgamations, you need to establish the type of resulting entity. There are different requirements for a new reporting entity and continuing reporting entity. And the accounting for acquisitions is largely consistent with PBE IFRS 3. And generally, the proposed standard is applied prospectively. Okay, so we now have some time for questions. Tracy, do we have any questions that we could share with the audience?
We don't currently have any questions, but if you'd like to put them through now, we'll keep monitoring those.
So I've either confused you all or it's been crystal clear. Okay, so if you don't have any questions, we will bring the webinar to the end. But if you subsequently think of things that you want to ask us, feel free to email us and we will provide a response. So thank you again for joining us on this webinar. And yeah, we look forward to receiving your submissions, and I hope you enjoy the rest of your afternoon. Thank you.